Yesterday, we heard from Jerome Powell in the Federal Reserve at the November FOMC meeting, and what we got was a 75 basis point rate hike, so another big one. But markets had actually already largely priced that in, and following that announcement, we saw some green across the board. Even gold and silver were catching a nice bid. But a very hawkish Jerome Powell quickly doused the hopes of the markets at the press conference that followed that announcement. And the message from Jerome Powell was very clear. The Fed will be keeping the pedal to the metal on these rate hikes, at least for now. So in today's video, I want to talk about what that means for the economy, what the Fed is likely to do moving forward, and also how we can all be getting prepared for this. So let's get to it. Hey everybody, Smart Silver Stacker here. I want to say a big thank you to all of you for tuning into today's video. If you get some value from it and you enjoy it, please do give it a big thumbs up down below. And while you're at it, why not subscribe to the channel? And also, today's video is brought to you by SD Bullion. So if you're looking to stack up some gold or some silver, definitely check them out with the link down in the description. So that was a very hawkish Jerome Powell indeed that we saw at the press conference following that FOMC announcement. And the message from Jerome Powell is pretty clear. The rate hikes are going to continue until the Fed can get inflation down to its 2% target. And Jerome Powell cited a number of reasons why he felt the U.S. economy could withstand these rate hikes and why he thought that it was important to prioritize fighting inflation. One of the things he cited was that the U.S. has a strong job market. There's still more job openings than we have workers to fill those positions. Of course, he didn't mention the fact that a lot of the job creation we've seen is in low-paying service sector jobs and that a lot of people are having to take on multiple jobs just in order to make ends meet in this, inflation-ridden economy that we have. Also, he cited strong consumer spending as a sign that the U.S. economy is still strong. Of course, he didn't go into the fact that credit card debt is at a record level and that most of that consumer spending is being funded by an increase in borrowing among consumers, and that consumers now are having to use consumer credit like credit cards just to make basic purchases like groceries. But I think part of the reason that Jerome Powell is hesitant to make any indication of a slowdown in the Fed rate hikes is because he knows that if the Fed pivots, we may be facing hyperinflation or just absolutely out of control levels of inflation and a complete devaluation, maybe the end of the dollar. It seems like Powell is sort of channeling his inner Paul Volcker here, although to me, Jerome Powell is like what you would get if you ordered Paul Volcker on Wish.com. If Powell really wanted to fight inflation, he would have to be as aggressive as Paul Volcker. You'd need to crank rates up to 19, 20%, make it the absolute priority, risk crashing the economy. But, one difference between now and when Paul Volcker was cranking up rates is that Paul Volcker only had to deal with a 35% debt to GDP ratio, something in that range, whereas today it's over 120%. So compared to 1979, when Paul Volcker was fighting inflation, the U.S. national debt, we're 3 times more indebted relative to the size of the economy. So, that makes it a slightly trickier proposition for Powell to get this inflation problem under control. Because, of course, it's not a problem with rates. It's a problem with out of control fiscal policy at the government level, constant deficit spending and borrowing into existence all this money and then spending it. And also, it's a problem of the money supply, the real old school definition of inflation. It's not rising prices, it's an expansion of the money supply, and it has nothing to do with rates. And if rates were going to be an effective tool to fight inflation, they would have to be a lot higher than they are today. So it seems like the only thing that Powell is likely to accomplish with these rate hikes is a further gutting of the U.S. economy. We're likely to see a stock market correction in a big way. We might see a housing market correction in a big way. And very importantly, we are likely to see some serious layoffs as a result of these rate hikes. He doesn't want to be the guy at the helm when the dollar is destroyed, when it loses its status as the world reserve currency, when it's massively devalued. But one thing I do think is going to change Powell's tune is when something breaks. Nothing is broken yet in the economy. It's just, kind of business as usual. We see asset prices correcting somewhat, but we could see asset prices correct a lot more before this is all over, because the strong economy, the economic recovery that politicians have been touting for years now, all of this is built on easy money. It's built on the actions of the Federal Reserve. It's built on them keeping interest rates near historically low levels for more than a decade. It's based on the Federal Reserve buying almost $9 trillion worth of assets over the past decade or so and injecting all of that cash into the markets. And if the Fed wants to draw down that balance sheet, if they want to hike rates back up, it means that all that fake economic strength that we have been touting for years now, it's all going to go by, because it's not built on any fundamental organic economic growth or productivity. It's all just based on easy money. So, very likely we are headed towards something breaking in the economy. Now, I don't know what that's going to be, whether it's going to be, banks failing, or possibly the risk of a U.S. government default if we see, the debt market start to break, if we start to see the rates on U.S. treasuries marching up rapidly. And, that's the sort of thing that's going to force the Fed to pivot, and it's going to force them to intervene. But before that happens, there could be a lot of economic pain in store for your average American, for you and me. It's very important that we be getting ready for this, folks, because what's coming is going to be a massive wealth transfer. It's going to be basically the biggest transfer of wealth in human history, I believe. And it's going to be a massive opportunity for anybody who is prepared. It's going to disproportionately benefit the wealthy. They almost always are the ones who benefit from these economic crashes, from these catastrophes, from these wealth transfers, because they're the ones who are in a position to buy up assets at fire sale prices. They're the ones who, when the Fed decides to hyperinflate the currency, they're the ones who own the assets, which are going to be appreciating. And they're the ones who don't have to worry about, their grocery bill next week. They don't have to worry about feeding their families, because, when you're a multi-millionaire or a billionaire, those things are taken care of, and so you can sit back and you have the luxury of taking advantage of these opportunities when they present themselves. But the good news is that there are some ways that we can be preparing ourselves. We can put ourselves in a position to take advantage of this wealth transfer ourselves. And what does that mean? Well, one of the big things you can do, get out of debt. Don't have consumer debt. Don't be somebody out there buying a bunch of crap that you don't need with credit cards with high interest rate consumer debt. Don't be contributing to that record high, almost $1 trillion now, consumer debt in the United States. The credit card debts are getting out of control. The delinquency rate is rising on them as well. Don't participate in that. Another thing you can do to get ready, if you get out of debt, stack up some hard assets. Get yourself some gold and some silver, and get some cash too. Don't be in a position where if you lose your job, or if your spouse loses your job, or you get some kind of unexpected expense, that you have to be out there selling off assets just to make ends meet. Try to make yourself as resilient as possible. And what that looks like is going to be different for everybody. Personally, I'm not a person of means. I've been driving the same old Toyota Camry for the past 18 years, but you know what that means? It means it was paid off a long time ago. I don't have any car payments. And what do I do with that cash every month that I save on making a car payment? Well, I've been buying silver. I've been saving it. I've been trying to pay down any consumer debt I have and get completely out of debt, because when the time comes to capitalize on these opportunities that present themselves, you need to be ready. You don't want to be someone who is being forced into bankruptcy during an economic crisis. You want to be somebody who can move and snap up assets at fire sale prices, and you want to be as resilient as possible. Also, it's kind of hard to predict what this economic crisis is going to look like. We have some examples around the world of what that can look like. Just take a look at Venezuela, for example. What did people need there? Well, they needed food. They needed essentials. They needed, day-to-day stuff. They needed drinking water. They needed soap. They needed the ability to, store some electricity, because the electricity wasn't on all the time. So, making yourself independent of systems of support will also put you in a very good position for the coming economic winter, because that's the season we're in. Now is the season of winter. Clearly, based on what the Fed is telling us here, they're sending a very clear signal. And that means that it is the time to get lean, to get as prepared as possible. Don't be somebody who's distracted. There's a lot of distractions out there today too. There's, smartphones, social media, sports, all sorts of things that you could be looking at aside from the oncoming economic train wreck. But don't get distracted. It's okay to relax and kick back and have a good time every now and then. But it's also very important to have situational awareness and understand where this is all heading. I'll be honest with you, folks, some people aren't going to make it. There's going to be people now who would consider themselves middle class, and very likely they're going to be homeless, possibly. They might be hungry. The severity of what is coming is, I think, off a lot of people's radar. We have this normalcy bias. Everything's been good for living memory. And so, people believe that it's going to keep on going. And if they just keep showing up to work, clocking in, clocking out, collecting a check, and just doing what they've been doing, contributing to their 401k, investing in the stock market, buying an index fund, that everything is going to be fine. But I'm telling you that folks who are on that plan, who are borrowing money to buy fancy new cars every year and who live in a house that they can't afford, those are the people who are going to be suffering. And unfortunately, I don't want anybody to suffer, but those are the people whose wealth is going to be transferred. Be somebody who can withstand an economic crisis, make yourself resilient, make yourself anti-fragile, and get ready, because just remember that following every economic winter, there is an economic spring. And that's why these periods of crisis, periods of pullbacks, they can really be an opportunity for people who position themselves in the right way. And so I urge all of you, get prepared, get out of debt, do what you can. Of course, it's not financial advice. I'm not telling you what to do. I'm just kind of giving you my thoughts. But it is a bit of a warning because it looks like things are going to get ugly. And I do think that the Fed is going to pivot at some point down the road. That's almost inevitable. That's what central banks almost always do when there's a crisis. But based on what Jerome Powell was telling us yesterday, there's going to be a crisis first. They're not going to blink. They're going to drive straight into a brick wall, basically. That just seems to be how things are going, and that's my take on it. So let me know what you think in the comments down below. Do you think that the Fed will just keep cranking up rates until something breaks? Do you think that they might blink and pivot before then? Love to know what you have to say. Also, let us know what you're doing to get prepared. And with that being said, I just want to say a big thank you to all of you for watching. Stay safe, everybody. Happy stacking. I'll catch you next time. Smart Silver Stacker, out.